Welcome to the seventh episode of the Datador Front Porch podcast. We have a packed show today. It's not a packed show. Wait, let's start again. Put a
They're all
mark in here.
packed shows.
Yeah, maybe it sounds better when we call it a packed show. All right. Welcome to the seventh episode of the Datador Front Porch podcast. We have an exciting show today. We will talk about the topic of the weekend, Silicon Valley Bank going under, and what that means for Opendoor. What is the relationship between Silicon Valley Bank and Opendoor right now? We will talk about listener certainty, something we heard about in the earnings call. We talked a little bit about it in our live discussion AMA on Twitter Spaces last week. Going to dive into that a bit more. And then lastly, we have a listener question on how current pending margins look like for Opendoor. So these are our three main topics today. Let's jump into the situation with SVB. It's right now. It's an evolving situation for us. It's Sunday evening in US time. The situation right now is that another bank, Signature Bank, failed, and the Fed stepped in and guaranteed full deposits for both Signature Bank and Silicon Valley Bank for everybody to get their money out on Monday, which is really positive after how the weekend went and how much screaming there was on Twitter. But more importantly, for this podcast is like, what was or is the relationship with Opendoor and how could this affect them? Tyler, do you have any information on that?
Yeah, so I commented about this on Twitter this past week when I heard about it. I heard from one of my sources who I trust that Opendoor has less than 1% of their capital in Silicon Valley Bank, and none of their critical business accounts are run out of Silicon Valley Bank, which was encouraging to hear. I mean, it's a moot point now because it sounds like no one's going to be missing their money anyways. But I will say there is a historic relationship between Silicon Valley Bank and Opendoor, and a lot of the founders of Opendoor have recognized the idea that without Silicon Valley Bank support early on, there probably wouldn't be an Opendoor. And I think that's probably the case for a lot of disruptive and private technology companies in Silicon Valley over the past few decades who have partnered with Silicon Valley Bank. So I think overall, and maybe this is a separate topic. I mean, when you look into the cause of all of this, it really does appear to be mismanaged funds. But I will say it's a huge blow for the startup community, and it's unfortunate to see because Silicon Valley was very important for founders.
Yeah. There's probably some other better podcasts to cover like what actually went wrong here. It probably wouldn't have just affected Silicon Valley Bank, but as we see now with Signature Bank, and probably some other banks that are in a similar situation where they have very long duration but low interest instruments that wouldn't be worth the same as they were when rates were lower. So if everybody is going to get for their money, the bank would probably not be able to cover the amounts of time in time. I guess that's what happened here. And the spicy thing here is because in Silicon Valley, it's a lot about herd mentality. Everybody's running into the same sectors. If it's crypto or like AI, everybody wants to fund the same things. Obviously, if the big VC companies tell their companies to pull out money out of Silicon Valley Bank, everybody else was also running after the money. So I think in the end, what happened on Friday is that 25% of deposits, like over $40 billion, got wired out, and that kind of resulted in whatever shock we saw after that. And the risk is that this could happen to other banks. So that's why the Fed stepped in and said, hey, all the deposits, not just the insured part, we will cover them from the right decision.
I think just to double tap on that, and like you said, this isn't really the podcast to go into exactly what happened, but I think we can we can simplify this a little bit. I think there's two things that you look for security in a bank when you have a massive deposit, right? One is how much of it is insured by the federal government, and only banks really have that designation. That's part of what gives them power as banks, right? Um, but then the other thing is how much liquidity does that bank have, and the liquidity profile, like how much cash do they actually have available in the event that there is a bank run so that they could cover all deposits, right? So that ratio is really important. And I think a lot of the really powerful banks in the United States, right? Like the JP Morgan, the Wells Fargo, Bank of America, those types of companies, they have massive liquidity profiles because of the 2008 financial crisis. But for Silicon Valley Bank, you look at what happened in the past couple of years. You think Opendoor mistimed mortgage rates and interest rates, right? Like Silicon Valley Bank uh, was even worse, right? They bought 80 billion of mortgage-backed securities when interest rates were near zero, trying to get a 1.5% yield. And then the Fed raised interest rates 75 basis points 4 times, and then again, 50, et cetera. And you're in a situation where those $80 billion of assets are only gaining 1.5% when your consumer bank at like SoFi or whatever is giving you 4%. People start wanting more yield on their funds. And I think because Silicon Valley Bank didn't have very much of their assets insured by the federal government, number one, but two, really just didn't have the liquidity um, compared to their deposits. They were in a situation where a bank run made it very easy for them to go under.
Yeah, it will be interesting what the consequences of this are in the next 2 months. I mean, people are speculating from like maybe uh, rate hikes will slow down or stop, which is obviously great for mortgage rates, probably, but who knows what else will break in this environment. Um, yeah, what is important to know is you mentioned, um, as far as we know, Opendoor only had a very small amount of money in Silicon Valley Bank. Obviously, public companies don't disclose who their lending or banking partners are. This is not part of any rules. I don't think anybody discloses that. So we don't know for sure if any of their lending facilities are there or not. But there's a really great podcast that Dot Fraser did on the podcast, The Operator. I think the podcast is from Damien, who is at Founders Fund. It's a very, very great podcast that gives you a history of Opendoor's capital stack from like founding to post IPO. I think the podcast is from 2021. I definitely recommend listening to that if you're really interested in how the sausage is made on the capital stack of Opendoor. And Dot specifically said that like Silicon Valley Bank was not the right partner to scale and like really get to the right cost structure.
Right. And I think that's the other point that's important to double tap here is Silicon Valley Bank would be a great partner for a risky, unproven business model, right? Like a startup. And because of that increased risk, their interest rates, right? How much they're expected to earn on those assets is a lot higher than you might get at a different bank. And that's okay, perhaps, for software companies that are more early stage, mid stage, and Opendoor early stage. But for a company like Opendoor, which is looking for 10% gross profit margins maximum, capital efficiency is really, really important. And you want the lowest cost structure for your debt, for your access to financing. And Silicon Valley Bank is absolutely not that person, right? Like it's just a different business model. And so I think really important upfront for Opendoor, but it wouldn't make sense for Opendoor to have any significant or large proportion of funding with Silicon Valley Bank at this stage of their life cycle.
Yeah. And I think that's really important to state like that because I see a lot of speculation on Twitter where, because of some headlines, people expect that the Opendoor is like 100% funded by Silicon Valley Bank. That's just not
I mean,
how this works.
it would make sense with what's been going on the past year if that was the end. But I mean, it's just not true. So
Yeah. All right. I'm glad we covered this. Likely, what we should expect by next week, or maybe we shouldn't anymore because of the announcement from the Fed. But like on Friday, a lot of public companies filed an 8K, a announcement of material impact to their business. So so Roku announced that they had like $500 million in Silicon Valley Bank. We hope that we will see something from this from Opendoor as well, because even 1%, if you're thinking about it on a quarterly basis, if that 1% would be gone, it would be kind of material. I think they would have until Wednesday to file this. They have a few days, but at this point, we might not even see that filing anymore because there is no material impact. So we might never know how much money Opendoor actually had in Silicon Valley Bank, but like, it's unlikely that it's a big amount.
I don't want Opendoor leadership, right? Like the C-suite to tweet like Elon Musk. But it would be nice every once in a while to just get a few comment. You know what I mean? Can you imagine if Carrie just logged on to her Twitter with, she's like never on Twitter, but if she just logged on and she was like, hey, we don't have any capital in Silicon Valley Bank, or we had X percentage. And just the sigh of relief from the investment community. Wouldn't that be a great use of social media? You know what I mean? From a like crisis management perspective and investor relations. I just feel like some of these things, it would just be really nice if it was just solved, with 5 seconds of work in a bathroom break.
Yeah, I totally agree. I mean, there is obviously something to it that you don't want to be on Twitter, especially when you're Opendoor, because basically 90% what you get is like hate, and your customers are not there. There's nothing that really is great. There's no advantage to your business to be on Twitter every day as Gary Wheeler. But in these cases, yeah, just like FYI, something like that would have been helpful.
Yeah, as long as it's not, everyone relax, everything is fine, don't worry. I feel like those are the code words for like, get your money out right now, right? We've learned that from Silicon Valley Bank CEO and obviously Sam Bankman-Fried. They both did the exact same thing. And then the next day the company went under. Wild.
Yeah, I guess in hindsight, it's also good to just wait a few more days, and then it probably resolves itself maybe as well. But
Yeah.
some more communication would be helpful.
Yeah. Well, I mean, at least we're around to kind of report the news, I guess. That leaves space for us. Maybe that's what it is. It's just like, oh no, Sebastian and Tyler will take care of it sometime.
We'll take care of investor relations. All right. Talking about taking care of people, Opendoor announced a really interesting new product on last earnings. It's called List with Certainty.
Mhm.
What List with Certainty is, it's currently a small experimental trial that looks really promising. I think that's what we heard from the earnings call. It's another option for sellers that come to Opendoor to sell their home for more. Basically, it means it's an option for sellers to list on the MLS. And that's a product that Opendoor had before. Like last year, it was always kind of a hidden option that can come here and they take advantage of the funnel. If you really want to sell an MLS, you can use Opendoor in the partner agent. What's interesting here is that Opendoor will give you a backup offer. So you list on MLS. Maybe your home is there now for 6 weeks, but you really need to move in 2 months. So you can see if you get any additional offers on MLS. And then if you don't, still take Opendoor's slightly discounted offer. It's kind of, it sounds very similar to sell the third party marketplace that they're building, just without the marketplace part, right, Tyler?
Yeah, I mean, I think we talked about a little bit about this before the show, but I think um, one of the things that you mentioned is it's very similar to like the Redfin product or the Zillow product, right? With the Premier agent or the Redfin agent. But the big difference here is that it has a certainty kicker, which is what you were touching on, right? It's like list your home with this agent, get better, more eyeballs, more traffic, etc. But with Opendoor, you also have an offer in your back pocket, which we've talked about this for the marketplace, right? Like that, this product can't be built anywhere else because nobody else is buying homes like Opendoor. And so I think that's that's a big value add here is that one, that Opendoor is the only one that can build this product and it has a greater value proposition than even Zillow and Redfin. But two, and this is another thing that we were talking about before the show, and perhaps even more important, is you don't need to build a marketplace for lists with certainty to have value, right? To be scalable. And that's what differentiates lists with certainty with the third party marketplace, right? The third party marketplace is going to be a tough thing to build. And we've already seen that because they walked back projections for what percentage of transactions this would be materially, right? It went from 30% to like 5% over the space of a few months, expected percent of transactions at the end of 2023. And the reason is because it's really hard to build a marketplace because you have to aggregate supply to create the demand. You have to create network effects. And so I think the third party marketplace has never been built before, and it's going to take a lot more work probably than they assumed upfront. And so that's kind of on one side. But the list with certainty, I mean, you can add that into any of Opendoor's current markets and really begin to see significant scale, especially since they're talking about 20 to 25% conversion for the list with certainty product in their one market.
Yeah. So in their early experiments, it showed that 20 to 25% conversion rate of real sellers. That means they're looking at sellers that actually ended up selling their home on MLS or some other means, versus 10%, which is the current conversion rate on the first party offers. So it's a way for them to monetize their funnel of seller leads, right? And they don't necessarily have to give them to like another platform. They don't have to send them to Zillow or to Redfin. They can do this in house. They have partner agents with a pretty solid economic incentive. If we look at what the seller would pay, they would still pay a 5% fee, which is lower than the 6% you would pay with a regular realtor. And that fee is then shared with the partner agent. It's likely if the economics are anything that they were in the past with their all list with Opendoor product, it's probably like 1.5% that goes to Opendoor, and then there's a part that goes to the buyer agent, and the rest goes to the partner agent. It's a pretty great capital light product, and on the fallback offer, obviously that fallback offer is this is kind of the drawback, right? You cannot give the same offer that you would have given if it wasn't listed on MLS. Because obviously, if the home lists once and then gets removed from the market, it's likely that the next buyer is looking at the history of that home and says, "Hey, that was listed, never sold." It likely is not worth what it was worth when it was initially listed, which gives a hit to the value of the home. So there's a discounted, a deeper discount for Opendoor when buying this home as well. Just an upside and a downside. It's a downside for the seller, definitely. And talking about downside of the sellers, for the seller, I think where I'm a little bit concerned here is there's going to be a lot of options for sellers, right? let's say in a year from now or a year and a half from now, they have their first party offer, they have their third party marketplace, and they have list of Opendoor. Three decisions. That is a decision that the seller has to make between three choices. Obviously, they will package it up in like kind of an interesting into a flow through the whole process that makes sense for the seller. You see your first party offer. If you're not happy with it, you have the options to list in a third party marketplace for a week with one showing. And then if you're still not happy with any of the offers, you can list those on the MLS with the backstop offer. But it's a lot less certain than what we had a year ago, where you go to Opendoor, you get an amazing offer that is at market rate because we had crazy home price appreciation, and there's no reason to not say yes to that. It's
I almost wonder if there's some sort of goal to list homes concurrently, like list on the MLS in addition to being listed on the marketplace. I don't know what the regulatory stance is on that, but from a consumer perspective, if Opendoor was just like, "Hey, we're in charge of selling your home. Uh, give us the information. We're going to list in the MLS. We're going to list on our exclusives marketplace. You can choose, but we'll assimilate all these offers for you, and explain them." You know what I mean? I feel like as a consumer, that would be most valuable to me, as opposed to, we study residential real estate, right? But if, let's say that we don't, and we're just trying to sell our home, like you said, if I have to go through this funnel and just be like, uh, I don't know, like I have three options and they all require a lot of fine print, that could be a little bit confusing. But if it's just like, "Hey, either take this cash offer or we will sell your home," that seems like an easier funnel for me to walk through, easier for me to convert. Um, and probably faster from a sales perspective for Opendoor as well, because if they're listing on the MLS and trying to get offers plus assimilating offers on exclusives, right? Those two things are happening at the same time, whichever one is faster wins, in that idea. But I don't know. We haven't gotten any commentary around that.
ideally I would go to Opendoor and tell them by when I need to have my home sold. If it's in 2 weeks, I'm gonna get the cashback. So the first party offer. Um, they tell me, hey, we can list it on the exclusives for a week with one showing to get you more offers. By the end of the week, I can select the offer that I want and I'm done. If I have 8 weeks to sell my home, they should just take care of that. And in the seventh week, show me all the offers I have. And I just choose whatever price or whatever buyer I like the most.
Yeah.
If you can really simplify it down, like as a seller, I don't care where the home goes, right? I just want it the
Right.
maximum price for.
Yeah, and that's kind of what I think we're both getting at, is selling a home, and we've talked about this in the past. Selling a home is just about finance. It's just, how do I maximize two things, right? Convenience and how much money I'm making. That's all that matters for selling a home. Buying a home, very different, very nuanced, very personal, right? Less about money. I mean, money is still important, but on the axis of importance, it's much lower. And so if we can simplify that process and just maximize convenience and seller equity, then I think that there's a great chance for high conversion. That said, one of the things that we haven't talked about before for lists with certainty plus their first party business is, here's the current situation for Opendoor in this down market where they've got these massive spreads, right? Opendoor is currently converting 1 out of 10 real sellers to buy their home, because they're offering such low prices for these homes, so they have a conservative buffer on their gross margins, that only 1 in 10 real sellers are converting. But in this one market where they're testing out lists with certainty, they're getting conversion of about 20 to 25%. And now these two figures compared to Opendoor's historical 30 to 35% conversion of their first party business, when they were placing offers at or slightly above homes values when HPA was going like this. And so I think what I'm most excited about for lists with certainty and the third party marketplace is finding a way to turn these unconverting real sellers into converting Opendoor customers, whether that's through their first party funnel, their list with certainty, or the third party marketplace. And so if there's a version of Opendoor in the future where they don't need to have such wide spreads, maybe we get back to I don't think we ever should get back to 35% because they're probably offering too much for homes for their cost structure for first party. But let's say we're back at like 25%, 20 to 25% for the first party business. And then, if you're able to get 10 to 20% for list with certainty, 10 to 20% for the third party marketplace, suddenly, even with the exact same amount of sales and marketing, advertising, et cetera, they have a much more monetizable funnel because all of those consumers that used to be lost because they said, I don't want to sell my home to Opendoor or at that price or whatever it was. Now they have different options for products that they can go through. And I think that's a very real possibility if Opendoor is able to get these products right.
Yeah, it's kind of the forcing function of the market we're in right now. And maybe that's a good thing. I'm pretty impressed how Opendoor is evolving their product. They're not just sitting on their hands and waiting for things to go back where it was last year. No, they're coming up with experiments. They probably tried a bunch of more things that we never hear about, but there's certain things kind of clicked with a lot of their sellers. And that's what they will double down on together with the marketplace. And they will get strong out of this wherever the housing market goes. And hopefully by the beginning of next year, things look a lot better. And they have another piece that just monetizes a lot better than even the business before. Yeah. Pretty exciting. We will hopefully hear more about that next earnings call sometimes in May. And talking about the next earnings call, how is the pen? We have a listener question from the Discord from iShark, and he's asking how the pending margins currently look like. Are we better? Are we improving? Or is the sentiment going to the other direction right now?
Yeah. So pending gross margins are definitely improving, and they have basically throughout the entirety of early 2023 and since October, really. Pending margins have continued to improve from negative to now they're well into positive territory. Still lower than we'd like for the company, and still definitely sub 4 to 6% contribution profit margin targets, but moving in the right direction. And I think to add a little color to that, because we're not going to share actual numbers for pending gross margin, I think that's really valuable data, and so we reserve that kind of thing for the Datador subscribers. But just sort of adding a little color to what margins might look like for the remainder of the year. One of the things that I think I'm most excited about as someone who's constructive on Opendoor long term is when you look at the percentage of home sales that Opendoor is currently seeing that are still the Q2 offer cohort. And by that, I mean homes that Opendoor bought between the months of April and August 2022. In Q4, it was 90%. In Q1, it's 60%. And in Q2, it's looking like it's going to be 40 to 55%, somewhere around there. But beyond Q2, that percentage is going to be sub 20%, I think, of all sales. And possibly, even lower than that. And the reason that that's important is because the gross margins on these homes that were purchased and sold after the Q2 offer cohort are spectacular, right? I mean, pretty much 10+% for every monthly cohort after September that we've seen so far. And I think that really has implications for Opendoor's bottom line as we move into the second half of the year. I think Q1 and Q2 are still going to be under tremendous pressure because not the majority for Q2 at least, but the majority of the homes in Q1 are still going to be Q2 offer cohort homes. In Q2, it's going to be close to half. And so I think they're still going to see a lot of pressure, a lot of margin drag. But after those quarters, it's really just going to be these homes sold with these massive fat spreads. And so I think Opendoor is going to surprise to the upside on margins as we move into the second half. That said, if we have some, existential shock to the housing market, like mortgage rates go up another 3% or something like that, I mean, Opendoor's probably hosed in that situation, but assuming that there's some semblance of stability in the macro, the second half of 2023 should be really excellent gross margins for Opendoor.
Yeah, we've seen, that was another listener question, is if we've seen any impact from the rising interest rates, because we've seen interest rates go from sub 6% or to over 7% in the last 45 weeks. If we look at the pending data, especially adjusted for seasonality, I don't think we've seen any impact on pending sales for Opendoor, right?
I think it's here. Let me pull it up. I think the one caveat to that would be volumes, right? Like I do think that volumes are going to peak in the spring. And I think those are going to be the highest for at least a year, probably. But if you look back at like 2022, for example, volumes peaked at the exact same time. So to your point, there's a seasonal element to that. I think that there's two things probably influencing that for right now. One, maybe some mortgage hesitation, some buyer hesitation, and the fact that there's not a lot of inventory available. But also, I think the second thing really driving a deceleration in pending volumes is that Opendoor just doesn't have any new homes, right? They're just not buying enough homes. They're selling more homes than they're buying, and I think because they don't have a lot of fresh inventory, the homes that they're currently trying to sell, or increasingly are going to be trying to sell, are the dregs of the barrel, the last home sold of the Q2 offer cohort, which I think are going to be really difficult to sell, and that's going to add inertia to their pending pipeline.
And obviously, it's really hard to tell where mortgage rates are going, especially with what happened at the end of last week. It's like the most likely outcome right now is mortgage rates are going to go down from here. But who knows? So, what 2023 is really not disappointing in the amount of excitement that it's just a roller coaster from start to beginning. So, yeah, that probably explains the really wide spreads, because like whatever happens, Opendoor is trying to get through this as unscratched as possible. So we will.
Yeah, I think that was actually a question on the Twitter Spaces too. Is if there was another downturn, what would happen to Opendoor? And I think reflecting on that, they really are pretty conservatively positioned in terms of the margins of their new cohorts at this point. I mean, even if things dropped the amount that they did in the summer of 2022, I mean, the cushion that they have is at least 2 to 3 times what it was at that time, and they're buying so few homes that the impact would be much smaller. I think it would be still a huge risk to the solvency of Opendoor's business, but they're positioned much more conservatively, much more poised for something like that to happen.
All right, that's some really good closing thoughts here from Tyler. That's it for today's episode. Make sure to subscribe and like this video. It really helps us out. You should also join our Discord at datador.io/community, and let us know if you have any other topics for us to discuss in future episodes, any questions. And obviously sign up for Datador Adams to see the numbers, the sales numbers almost in real time, and hear what we have to say in specific. All right.
Yeah.
Thanks, Tyler.
Yeah. Thanks, man.